Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I'm going to analyze American Express stock to see if it's one of the best dividend growth stocks in this high inflation market. Before I start, I want to give you some context first. At the time of making this video, the entire US stock market is in a large bear market. The S&P 500 is down more than 20% from its most recent peak. The Nasdaq is down even more. It's down more than 30% from its most recent peak. The biggest reason for this bear market is that the US inflation is still near a 40-year high. Right before making this video, the US Fed announced another 75 bps rate hike. The US Fed will continue to raise interest rates aggressively until inflation is back to the 2% target inflation. This means US stocks will continue to have more corrections going forward until the US Fed stops raising interest rates. To go through this bear market, I will talk about whether American Express stock is one of the best dividend growth stocks when inflation is high. I will cover these topics in this video. First, what is American Express closed-loop payment network compared to Visa and Mastercard? Second, American Express two biggest risks you should know. Third, American Express economic moat's competitive advantage and long-term prospects. Fourth, American Express stock valuation. And fifth, will I buy American Express stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent and create many excellent investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. As you may already know, American Express is one of the largest credit card companies in the US. American Express is the third largest payment network in the US behind Visa and Mastercard's payment networks. American Express business model is very different from Visa and Mastercard. American Express is also a bank because American Express acquires merchants to accept Amex cards, issues credit cards to consumers and businesses directly, and gives out personal and business loans to consumers and businesses. If you look at this here, you can see that American Express runs a closed-loop payment network. American Express is the issuer bank that issues Amex cards to customers, the payment network that processes transactions, and the acquire bank that acquires merchants to accept Amex cards. In comparison, Visa and Mastercard are what you call open-loop payment networks. Visa and Mastercard actually do not issue credit cards and do not acquire merchants like American Express. Visa and Mastercard are payment networks, and their primary customers are banks. Visa and Mastercard rely on their banking customers to issue credit cards and acquire merchants. Also, Visa and Mastercard do not give out personal and business loans like American Express. So how does American Express earn its revenues? If you look at the latest financials here, you can see American Express earns non-interest revenues as well as net interest income. This is similar to US banks. The main difference is that American Express earns the most revenues from non-interest revenues, such as discount revenue charged to merchants. In the recent quarter here, non-interest revenues made up about 82% of total revenues. American Express earns much less net interest income from loans compared to non-interest revenues. In the recent quarter here, net interest income made up about 18% of total revenues. Here's the important part of American Express business model. American Express issues credit cards, personal loans, and business loans to its customers directly. To cover any credit losses, American Express needs to set aside provisions for credit losses every quarter to anticipate any bad debts and potential loan losses if Amex customers cannot pay off their loans and credit card balances on time, especially when we're heading into a recession. Here's another important part of American Express business model. Let's look at the past 10 years financials here. During the years when the US economy was growing steadily, you can see American Express total revenues, operating income, diluted earnings per share, and operating cash flows were growing steadily over time. This is because consumers and businesses will spend more using their Amex cards when the economy is doing well. Credit losses are also much lower when the economy is doing well and when the unemployment rate is low. However, during recessions such as the 2020 pandemic, when the US economy was not doing well and when the unemployment rate was high, you can see American Express had much lower network volumes, much higher provision for credit losses, lower total revenues, and much lower earnings per share. This is because most consumers and business owners will decrease their spending when the economy is not doing well. Some of them cannot pay off their Amex credit cards and loans on time when the economy is in a recession and when the unemployment rate is high. I believe American Express' biggest risk is credit risk during a deep recession. I said this earlier, whenever the economy is in a deep recession and whenever the unemployment rate is high, we can expect that American Express will have higher credit losses because more customers will not be able to pay off their loans and their credit cards on time, which will lead to lower values and lower earnings per share for the company. At the time of making this video, I believe the US economy is likely heading into a hard landing recession over the next 12 months because the US inflation is still near a 40-year high. The US job market is still very tight. Energy and food prices are still very high. The war in Ukraine is still ongoing. There are still supply chain issues around the world. Many businesses expect that the US economy will slow down a lot in the upcoming quarters. And the US Fed will continue to raise interest rates aggressively until the US inflation is back to the 2% target inflation. In my opinion, all these macro headwinds will lead the US into a hard landing recession. I believe it is nearly impossible for the US economy to have a soft landing now. Similar to the Great Inflation period in the 1970s and early 1980s, the only way for the US Fed to bring inflation down significantly is to keep raising interest rates aggressively and to have very restrictive monetary policies for some time, even if it will cause a hard landing recession. The US Fed is trying to prevent high inflation from being entrenched in the US economy. If high inflation becomes entrenched, it will be a lot harder for the US Fed to fight inflation later on. A hard landing recession and a high unemployment rate are the biggest risk for American Express because they will lead to higher credit losses for the company. This credit risk applies to all banks. Management said this, explaining that the biggest risk for American Express is the high unemployment rate. Our risk in an environment where you have inflation lasting for a long time is really only if and when you see unemployment spike. So at the point at which inflation trends cause the economy to crash, unemployment to spike up, small business failures to go way up, well, that's a cycle. That's not good for us. If you look at the recent quarter here, you can see American Express had total provisions for credit losses of $410 million. This is much higher than the previous quarter's provisions for credit losses. American Express is building up reserves for credit losses because the US economy is likely heading into a recession in the upcoming quarters. Or management believes that the unemployment rate will likely increase going forward. Or management believes that there will be more macro headwinds going forward. Going forward in the upcoming quarters, I believe American Express will likely have higher provisions for credit losses to anticipate the worst case scenario, which is a hard landing recession. Another thing I should mention is this. Under the Basel III Accord, all US banks are required to meet the minimum capital ratios to make sure that they have enough equity capital and reserves to cover any potential losses. This is to prevent banks from becoming insolvent and not being able to operate because of credit losses, especially in a recession. Generally speaking, if a bank does not meet the required minimum capital ratios, the bank needs to increase its capital before it can buy back shares and pay dividends to shareholders. The two most important capital ratios are the Common Equity Tier 1 capital ratio and the Tier 1 capital ratio. If you look at American Express financials here, you can see American Express Common Equity Tier 1 ratio was 10.3%, which was higher than the minimum Common Equity Tier 1 ratio of 7%. American Express Tier 1 capital ratio was 11.2%, which was higher than the minimum Tier 1 capital ratio of 8.5%. Management said that they will maintain capital levels and ratios in excess of the minimum regulatory requirements, specifically within a 10% to 11% target range for American Express Common Equity Tier 1 risk-based capital ratio. The second biggest risk is increasing competition with other major credit card networks. There are 4 major credit card networks in the US: Visa, Mastercard, Amex, and Discovery. Visa and Mastercard have the largest credit card market shares in the US and in the world. American Express is the 3rd largest credit card network. According to this article here, Visa had a market share of 53%, Mastercard had 24%, and American Express had a 20% market share by network purchase volume in 2021. In terms of market share by network outstanding balance, Visa had a market share of 42%, Mastercard had 27%, and American Express had 10%. Visa and Mastercard are much more popular among consumers and are widely accepted by most merchants compared to American Express. The biggest reason is that Visa and Mastercard are open-loop payment networks, while American Express is a closed-loop payment network. This from Morningstar explains American Express' biggest competitive advantage. In our view, American Express has a wide economic moat as we believe its differentiated operating model has allowed it to build maintainable competitive advantage that will allow the firm to continue to generate returns on equity well above its cost of capital for the foreseeable future. American Express operates as a closed-loop network for payments made by its cardholders. This means that American Express issues the credit card to the consumer, operates the payment network, and establishes a direct relationship with the merchant. By operating as a closed-loop network, American Express can capture the full economic profit from a single credit card payment. As a result, it generates most of its revenue from discount revenue and card fees, with non-interest income making up roughly 80% of its revenue, unlike other credit card issuers that typically rely heavily on net interest income. Not being as reliant on interest income helps allow American Express to build a strong competitive position in credit cards for high-income individuals and businesses, as both groups are less likely to maintain large outstanding balances on their cards. American Express' strength in these spaces has allowed it to remain effectively tied with Chase as the largest credit card issuer in the US by purchase volume. In order for a network to convince the merchants that they should accept its payments, the network needs to have enough users to encourage acceptance. But until a network has broad acceptance, it's difficult to attract users to its platform, making it difficult for new competitors to enter the market. Additionally, credit card networks have become deeply entrenched in US retail payments due to the reward structures that come attached to credit cards. While smaller than Visa or Mastercard, American Express network has historically been able to charge rates that match or even exceed its large rivals due to the higher spending rates on the company's consumer cards and its strong competitive positioning in commercial payments. Additionally, the costs of running a network are mostly fixed, so incremental revenue from additional purchase volume drops directly to the network's bottom line, further advantaging existing networks over potential entrants that will not benefit from scale. Management also said this explains American Express' biggest competitive advantage, which is its closed-loop business model. The one thing that's really hard to replicate, and we haven't used these words, but this enclosed cycle that we have otherwise known as the famous closed loop. The ability to have those merchants and have those card members and to be able to feed off one another from a value perspective is really critical. And the value that we're able to provide merchants with high spending card members and the value that those merchants are able to provide to our card members is really important. We maintain direct relationships with both our card members as a card issuer and merchants as an acquirer, and we handle all key aspects of those relationships. These relationships create a closed loop in that we have direct access to information at both ends of the card transaction, which distinguishes our integrated payments platform from the bank card networks. American Express' biggest competitive advantage is that it runs a closed-loop network that's very hard for competitors to copy. Also, American Express card members tend to be wealthier, have great credit, have higher income, and have higher spending every month compared to customers who mainly use Visa and Mastercard. For example, if you look at American Express' latest financials here, Amex customers spend an average of $6,000 in the recent quarter. Amex cards usually have higher annual fees and better travel rewards compared to other credit cards. One of the biggest reasons is that American Express tends to charge the highest discount fees to merchants for accepting Amex cards in their stores. For example, if you look at this here, you can see the average merchant discount rate is 2.35%. This means for every $100 you spend using an Amex card, the merchant needs to pay American Express on average $2.35. Then American Express will keep a portion of the discount revenue and give you more membership points to encourage you to spend more using Amex cards. Here's another important thing that I believe is very hard for competitors to copy. American Express has a large network of high spending and high income customers. These high spending customers like to use Amex cards even if the annual fee is high because they can earn high travel rewards and membership benefits. The downside is this: American Express has one disadvantage compared to Visa and Mastercard. Amex cards are not as widely accepted as Visa and Mastercard, especially outside the US. The biggest reason is that American Express usually charge the highest discount fees to merchants compared to Visa and Mastercard. Most merchants that sell cheaper products and services do not accept Amex cards because the merchant discount fee is too high. But many merchants such as brand stores, high-end restaurants, and airlines that sell much more expensive products and services will accept Amex cards. This is because Amex customers usually have higher spending compared to other card members. In terms of long-term prospects, I believe the US economy is likely heading into a hard landing recession over the next 12 months because of high inflation and the US Fed's aggressive rate hikes in order to fight inflation. Also, many European countries are already heading into a recession because of high inflation, high energy and food prices, the ongoing war in Ukraine, supply chain issues, and many other macro headwinds. This means we can expect American Express will likely have lower revenue growth and higher provisions for credit losses in the upcoming quarters if the unemployment rate increases a lot in the US and many countries. For example, if the US unemployment rate increases from 3.7% in August to above 5%, then American Express will have much higher provisions for credit losses, have more bad loans to write off, and have lower values and lower earnings. In the long run, when the US economy is growing steadily, and when the US unemployment rate is low, we can expect that American Express will have high revenues, high operating income, high earnings per share, high free cash flows, and growing dividends over time. In terms of guidance, American Express is raising its full-year revenue growth guidance from a range of 18% to 20% to a range of 23% to 25% in 2022. This is a good sign because it shows that American Express is growing even in this high inflation market when most companies are reporting lower revenue and lower earnings. The biggest reason is that American Express premium customer base tends to be wealthier, have great credit, have higher income, and have higher spending. Even if inflation is high, most of American Express premium customers can still afford to buy many non-essential products and services, go travel, and still maintain their spending. This is from the most recent earnings call that explains American Express premium customer base. A critical competitive advantage is our global premium customer base, which is at scale unrivaled in the industry, with millions of high-spending super prime loyal consumer and business customers across generations and geographies. Importantly, millennials and Generation Z customers are a large part of our existing customer base and our fastest growing age cohort, making up 60% of all new consumer card members. We're acquiring around 75% of new US consumer platinum and gold card members. In terms of long-term guidance, management expects that American Express can achieve 10% or more in annual revenue growth and mid-teens earnings per share growth in 2024 and beyond. Management said this: in any environment, we remain committed to executing against our growth plan and running the company with a focus on achieving our aspiration of delivering revenue growth in excess of 10% and mid-teens earnings per share growth on a sustainable basis in 2024 and beyond. Warren Buffett owns 20% of American Express. Warren Buffett has been a long-term investor in American Express for many years already. He likes to invest in great companies that have first-class CEOs, great economic moats and competitive advantage, great long-term prospects, a lot of free cash flows, consistent dividend growth, and consistent share buybacks. If you look at this here, you can see American Express has been buying back shares and reducing the number of shares outstanding consistently for many years already. Also, the company has been growing its dividends consistently for many years already. I want to show you how to calculate American Express stocks intrinsic right here. If you want this calculator, you can download it in my Patreon blog in the video description. These are the key assumptions in this calculator. First, I define American Express intrinsic value as its future free cash flows discounted to the present day. The discount rate is 10%. You can use a higher discount rate here if you want to be more conservative. I'm using American Express most recent 3-year average free cash flow here, which is $9.73 billion. Based on the long-term prospects I talked about earlier, I believe American Express free cash flow will grow at a compound annual growth rate CAGR between 7% and 13% over the next 5 years. Again, management expects that the company can achieve more than a 10% annual revenue growth rate in 2024 and beyond. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're using a compound annual growth rate CAGR of 7% over the next 5 years. If we forecast American Express free cash flow over the next 5 years, and discount the free cash flow to the present day, American Express intrinsic value should be around $99 billion for the entire company, or $132 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're using a compound annual growth rate CAGR of 10% over the next 5 years. American Express intrinsic value should be around $120 billion for the entire company, or $159 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're using a compound annual growth rate CAGR of 13% over the next 5 years. American Express intrinsic value should be around $143 billion for the entire company, or $190 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, American Express intrinsic value should be around $160 per share. In comparison, Morningstar estimated American Express intrinsic value to be around $166 per share. This means I believe American Express is likely undervalued at the time of making this video. So will I buy American Express stock? At the time of making this video, I don't have any American Express in my gold stock portfolio here. This is one of my personal gold stock portfolios. I have Visa and Mastercard in my portfolio here. Personally, I like American Express closed loop payment network and its long-term prospects. So I would likely buy American Express stock for the long term when it becomes substantially undervalued. For example, I would likely buy American Express stock for the long term if it's at 20% below my interest value value estimate here because I want to reduce risks and have a larger margin of safety. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.